Mhm.
Yeah, so welcome. Glad to see y'all jumping on. Glad to see people still coming in the room. Talk about some exciting stuff, trading, and what I call and feel is the greatest business on the planet. Nothing like putting your money somewhere and letting it work for you so you won't have to do the physical labor. That's one of the things I've always loved about trading. I can send my money to work and let it go do the work. So that's one of the things we're gonna talk about getting started with lesson 7, y'all. Let's jump into it. And I'm gonna turn the call over to Thor Samuel so she can, take us through our disclaimer, and then we're gonna stay with Thor because she's gonna also take us through our quizzes, and we'll be ready to jump right into lesson 7. Are you ready for us, Thor?
Yes, I am. Okay.
Okay.
Trading and investing carries a high level of risk. You could lose some or all of your investment. Trading commodities or any other financial instrument may not be suitable for all investors. Before deciding to trade, you should carefully consider your investment objective, level of experience, and risk appetite. We accept no liability for any losses or damages you may incur. This means that you alone are responsible for your actions in any trading or investing activities.
Thank you. Thank you so much. We're gonna stay with you, Thor, if you can. Walk us through our quizzes. Um, it was 2 at least, maybe 3. I can't remember.
Three, yeah,
3?
yes.
Okay.
So the first one. Top and bottom formations indicate support or resistance. Is it true? Oh, sorry. Is it A, false, B, true, C, maybe, and D, not sure?
I know y'all know the answer to this now. Come on.
True.
Say true, Paula?
I did.
Okay.
Okay. It is true. And anybody else have anything different? Okay, so
Right.
true it is. The second one on May 10th. Okay. In some cases, gaps form on the chart. These gaps are filled at a later time in most cases. I read it again. In some cases, gaps form on the chart. These gaps are filled at a later time in most cases. Is it A, false, B, true, C, never, or D, not sure? Say,
Be true.
okay.
All right, Alice, say true.
Anybody else? You want to have anything different?
Anybody else?
Agreed.
Paula says she agree.
Okay.
Anybody disagree, Thor?
No, no.
Okay.
Yeah,
Great job. Great job.
okay. And the third quiz, we got a lumber chart. And the lumber chart had gaps on it. We were to answer if all the gaps had been filled.
Yeah,
So,
Thor, you weren't able to share your screen with you on that one. If not, that's okay. Don't worry about it. But go ahead, Thor.
okay, you want me to share? Yes, I will.
Well, we'll be able to see this chart that you're talking about, but if you can't,
Yeah.
that's okay. We went over gaps last week, so for those that need to see them again, that's okay. The more you look at it, it'll make sense to you.
Are you seeing my chart? Are you able to see my chart?
Yes, we can see you. Thank
Okay.
you.
This
Now
is
read the quiz again for us.
okay. This lumber chart has gaps on it. Have all the gaps been filled? That's happening. Hey. Something went wrong here. Right, there you go. Sorry about that. So
I
this is the
said
lumber chart.
no. No.
Alice said no.
No.
Joy said no. All the gaps have not been filled. That's what you're saying, Joy. Alice, right?
Yes, sir.
That's right.
On the
So,
chart. No, all have
so
been
what
filled.
about this big gap that was on the chart? What has that one been filled?
No.
No, sir.
That's the last one waiting to be filled, right?
Mhm.
And it's
Yes,
a big,
sir.
a real big one.
Yeah.
All right. So thanks a lot, Thora. We appreciate that.
You're
Great
welcome.
job on
You're
everybody
welcome.
in the quiz. And if you could stop screen sharing now, Thora,
Okay.
appreciate that. So we went into lesson 6 last week, talked about gaps, and that's why we had some quizzes on gaps. And now we are ready to talk about and get into lesson 7. And Johnny got the screen up now. What we got for lesson 7, Johnny?
I think we're going to understand a little bit about buying low and selling high, and talk about trends and a little bit of proper risk management.
All right, all right. And I got a feeling, I could be wrong, Johnny, but I got a feeling that probably was meant to say selling high and buying low. But nevertheless, we can see with the next chart that, yeah, that's what it was probably meant to be. So, and Johnny have, talked about many times how this is one that we've spent a lot of time on. And this is a concept that could be new to you if you've never heard of it. But we may have at some point in time have heard of the fact that we can get in the market and buy something when it's trading at a lower price, and then we can sell it when it goes up to a higher price. We may have heard of that concept before. And that's a concept that's called buy low, sell high. Most people are familiar with that. Buying something low and selling it higher than what we bought it for. Pretty common concept that we all maybe heard at some point in time. But there's another concept that we can take advantage of in the market. We want to look at and understand how that works. We can actually trade and take advantage of the market going down and make money. And the concept that I'm talking about is just the opposite of what I just explained about buying low, selling high. This concept is called selling high and buying low. What does that mean? That means that we can get into the market when the price is high, when the price is up, and when it goes down, we can get out of the market and we can profit from the market doing that. So we hear a lot about the fact that the market been a bear market, it's been trading down, and that's been a big topic about the market. But we can also take advantage of the fact that the market trades down, and that's the concept of the bears winning when the market goes down versus the bulls winning. So buy low, sell high, and then we can do what's called sell high, buy low. So Johnny, you want to start off by talking about this, or you want me to?
I'll let you go ahead.
Okay. So I'm gonna use some analogy and a little story, like a little situation I want to use to try to kind of paint the picture using something outside of the market as an example that works the same way. Okay. And I want you to listen to me because I want you to understand the example I'm giving you works the same way in the market. All right. So I'm using an example of a car that I happen to like. I happen to be someone who likes the Yukon. Actually, the Denali Yukon is one of my favorites. I like the Yukon, and I'm thinking of getting one. All right, and I think I want to get this for my birthday in September. And I happen to have a friend that lives in Texas named Johnny B. Scott. He's in the car business, and I want Johnny B, to actually be the person I get the car from. So it'll be a win-win. He can make some money, and I can get the Yukon that I want to get. So I want to reach out to Johnny B and see if he can, get this Yukon for me that I want to buy in September. But I don't want to pay more than $50,000 for the car. All right. So I reach out to Johnny B. Scott and tell him I'm looking to purchase a Denali Yukon in September. And I got a limit. 50,000 is my limit. And me and Johnny B agree that he feels he can get the car for me in my price range. And we agree and we do the deal. Now it's April right now, but we just made the deal and did the deal for my Yukon that I want in September. All right. So Johnny basically just sold me a Yukon for $50,000 that he's gonna deliver to me by September. Now, in order for Johnny to make money on this deal, since he already sold the car for $50,000, he needs to locate and find a Yukon for less than $50,000, right? Because he already sold it for $50,000, so he knows what he's getting from me. He needs to find his car for less than $50,000. So if he can find a Yukon for 45, and he's selling it to me for 50, is Johnny B gonna make a profit in September when he delivered the Yukon to me? If he purchased it for 45 and he sold it to me for 50, that's a $5,000 profit. He sold it high and then he bought it low. So he sold it first. That's the difference I want y'all to understand. When we trade the market to the upside, we buy first and then we sell second. In this concept of trading market down, you sell first and then you buy second to get out. So this what Johnny's doing. He sold it for 50,000. He found it and bought it for 45. So he sold it to me first. He already knew what I was gonna pay. He had to go find it for less than that in order to make a profit. And that's the same concept of trading in the market when we trade the market to the downside. Now, had Johnny found this car for 50,000, that's the best he could find it for, and he bought it for 50,000. Did he make money on that deal? No. At this point, he broke even because he sold it to me for 50, and he found it and bought it for 50. So he didn't make anything, he didn't lose anything. But if he would have found it, he couldn't find it nowhere. The cheapest he could find was 55,000. And he got to deliver this because he already got a deal contract with me already. And he buys the car for 55,000. Did he make money on that? No, he lost 5,000 because he sold it for 50 and he ended up buying it for 55. And that's the same concept as the market going against you. And the market went against him, traded in the other direction. And he lost on the deal. Anything you want to comment or add, Johnny B? I want people to understand this concept.
Yes, sir. I do have something I want to add.
Okay.
In this analogy, why do I want to cut this deal? Okay. In other words, let's say, for instance, he wants a 2025 but I know that by September, the new models are going to come out, and this model he wants will be discounted. So I don't want to wait until the model is discounted because he's willing to buy it today. But I'm banking on the price going down between now and September. I want to hedge, or I want to protect my investment, or I want to protect it by saying, I'll go ahead and sell now because I think by September it's going to be lower. That's the gamble I'm taking. But at the analogy he uses, if it goes up because all the models sold out and there's very few left, and I cannot, I have to pay premium, then it didn't work for me. But we look every day of the week and we see the market at all times high, and we know doggone well it's not going to stay there. So how are we going to protect ourselves, or how are we going to profit from the perceived future market going down? And that's where we can sell now at a high level and buy back later at a lower market price and make the difference. Okay? So there's usually a reason why we're doing this. It's to either hedge or protect yourself, or if you are a producer. But as a speculator, you're speculating on the price going down in the future because it's sitting at an all-time high, or it has hit the cycle high for right now, and you want to take advantage of the market going back down. That's where we sell high and buy back low to get out.
Yes. And Johnny, it's just the opposite of what we typically know or typically think of, even in the car analogy, and that even in that scenario, what happens most of the time,
Well,
and that in a normal time,
yep,
Johnny will go and he would probably just go to an auction, or he would just order from the manufacturer. He will buy cars and just sit them on the lot. So he will buy them first, and then needing people to come online or either come to the dealership and buy them. So he will buy first, and then he would sell them for higher than what he paid for them. So that's the concept we used to. But in this case, he sold me a car he didn't even have yet. Did you try to say something, Johnny? What?
yeah, and that was the point I was trying to make, is most of us can't perceive the fact that we can sell something we don't already own.
Right.
And in the futures market, we can,
Mm-hmm.
or in the options market, we can.
Yeah. And you know, this is the concept we normally have to spend some time on, because it takes a minute to wrap your head around the fact that the market's trading down, and you saying that we can make money trading the market when it's going down. Yes, that's what we're saying. And I like the fact that, you know, Josh always says, you know, if it's a concept that you don't understand, or if it's a concept that you choose not to do, that's what's so beautiful about trading the market. As Eric always said, it's so customizable. If this is something that someone said, I just don't get it, or I just don't want to do, you don't have to ever trade the market down. That's the beauty of it. You can just trade the market up if that's what you choose to do. And you know, that's fine. There's nothing wrong with that. But we want you to know that there's two sides and two ways that the market trades. It trades up and down, and you can trade both directions. But understand the concept of you can actually sell something you don't own by selling it high and then buying it low. And another thing we want to point out too, when it comes to this concept, is that I mentioned that I wanted the car in September. But Johnny, do I have to wait till September?
No.
I can get the car before then, right?
Yes, sir.
If everything happens, you find the car sooner, you find the car in May. And that's the same thing when we trading. We may be trading a December contract, but doesn't mean that we can't make a profit and get out of the contract way before December. And it's the same thing. Johnny can find the car way sooner, and I can pick up the car and have the car before September. But he know he has until September
Oh,
in that analogy.
let me ask you a question. What happens if we're going down the road and you decide you don't want the car? Can you sell that contract to somebody else?
Yeah, John, I changed my mind, man. I don't want that car, man. I think I saw this Range Rover I want instead.
So you sold it to Thora,
Hmm.
and now I owe a car to Thora.
And that happens over and over and over again, right?
Right.
So it's just we use some analogies to everybody just to try to help you understand it, you know, because I know to some it's new, and to some they may be familiar with it. But we want you to understand the concept. So that's why the car scenario always seem to be a good one to use. But I hope this is, you know, making sense. I hope this helps understand what happens when we in the market, and whatever it is, if it's soybeans and you sell at $11 and the market trades down to $10 and you get out at 10, that dollar profit that you just made because you sold it first and then you bought it second, you buy to get out of the market. In the other scenario, we buy first and we sell to get out of the market. So hope this makes a lot of sense. If it's not, please write all the questions down so when we open up for questions, you can ask all the questions you have, because we always have questions about this. Anything else you want to talk about on this, Johnny, before we go to the next slide?
Well, I was going to suggest that why would we want to look at that? You know, why would we want to use this strategy? Because the trend is changing direction. So what is a trend? Okay. A trend is a direction the price moves within a formation on a chart. Prices can move down or a downtrend, which is our 1, 2, 3 top formation. It can be an uptrend, which is the 1, 2, 3 bottom formation, or it can be a horizontal or a sideways channel. Those are the 3 trends we look at. Okay. So
Yep.
Go ahead. I'll let you want to do this slide.
No, I was just trying to say, you know, that's something we talked about in the rules, about following the trend and being on the right side of the trend.
Right.
And the
It
market
says right
trades and trends, you know.
It says right here, the trend is your friend.
Go ahead, Johnny. What we got?
Okay, this is an illustration of an uptrend. All right. Now, when we draw our trend lines, we usually draw it on the top and the bottom of the trends. Okay, and a trend is indicated by higher highs and higher lows. And you can see this throughout the chart. And a trend is confirmed when it touches the top trend line 3 times. Okay. So, and it will continue on until it breaks that trend and goes the opposite direction or sideways.
So, John, you're saying we want to see at least 3 hits on that trend line.
Correct.
Just confirm that that trend is intact, right?
Correct.
Yeah.
And you can see that clearly here on this chart. Okay.
Yeah.
Now, a downtrend is just the opposite. Downtrend is represented by lower lows and lower highs. Okay. Now we talk about minor trends and major trends. Okay. That determines the time of the trend.
Johnny, when you saying, you know, these higher highs and higher lows and lower highs and lower lows, is that the same as support and resistance? You're just saying lower lows, lower highs, but it's still lower support and lower resistance?
Correct.
Same thing, right?
Yeah. So
Yeah.
this would be in when it's going down, okay, this represents resistance and this represents support, you know, and then on the other, forgive me, right, so this upper line would be resistance It goes up and hits resistance, falls back down to support. Resistance, support, resistance, support, so on and so forth. Okay. So it goes down on here and then goes back up. All right. So this represents a downtrend. So let's go back to what we talked about earlier. So if we've had a 1, 2, 3 top, knowing that the market's now going to go the other direction, would we want to be buying, at, let's see, come on. Would we want to be buying here? And selling here? No, we want to be selling here and buying back here or here. And we want to take advantage of this price move going down. Okay. All righty.
Nice. Very nice, Johnny. But
Okay.
we need to understand that.
Now, this is a major uptrend, one that goes for a long period of time. But it's still an uptrend, indicated by higher highs and lower lows. I'm sorry, higher highs and higher lows. That's what I meant.
Absolutely.
We've talked about this before, where we go into a trend. So we had an uptrend, and then we had a 1, 2, 3 top, followed by a downtrend. Okay. Here you have an uptrend, followed by a downtrend, followed by a sideways trough. We hit bottom, and then we had a 1, 2, 3 bottom formation, which changed the current trend. So test question. 1, 2, 3 bottom. Has the trend been established yet or confirmed? And the short answer is no, because it hasn't hit the top line 3 times. But would we, in fact, buy this formation? And the answer is yes. And of course, we would buy it when it comes back and tests the 2. All right.
Which will actually be hitting the line for the 3rd time, look like, Johnny.
Yeah, it really would.
Mm-hmm.
So again, when Delvin says the charts talk to you, this is over a period of time from June to September, and it changed directions twice.
Yes, it did, Johnny.
Okay. And here again, what we're trying to illustrate to you here is going from a downtrend to an uptrend. And you can make money on both sides of that.
Mm-hmm.
We're going to touch on it on this in this lesson, okay? But here's an illustration of where we had a trend that went into a sideways channel, okay? And that sideways channel is equal highs and equal lows. It just trades within a range. Delvin, I know you like to trade these. Would you like to talk about this?
I do, Johnny. It's out of the three, it happens to be my favorite because it's easiest to spot, in my opinion. When we're looking at the charts, you know, if you look at the three formations we watch for, 1, 2, 3 top, 1, 2, 3 bottom, and the sideways channel. The sideways channel is the easiest to to spot on the chart to me. And I like to trade it because I also feel it's the easiest to trade out of those. So,
Can I ask you a question?
absolutely.
When this breaks out of a sideways channel, there's only two ways it can go.
Right.
So how do you trade that?
And it takes a lot of guesswork out too, Johnny, because it's trading out of the sideways channel. I just let the market tell me which way it's gonna go. You see? So what I do in this particular case is I put myself in position to enter the market on either side of this channel, whichever side it breaks out, whether it's the upside or the downside. I'm in position to get into the market when it breaks out of the channel because I like the fact that in a lot of cases when it breaks out of the channel, whichever direction it breaks out in, a lot of times it'll keep traveling and trading in that direction. So I have an order in to get in on either side, Johnny, and one of my orders is going to get filled. And when I get filled, I'm either going to be long, trading it up, or I'm going to be short, the market trading it down. But I love those channels because I can be in place, put myself in position to catch the market on either side when it breaks out of that channel. In this case, it broke out to the upside. I mean, I would have caught fill on my order and I would have been trading it and been long the market, Johnny.
Okay. And so we traded this up and what happens when it hits the 1, 2, 3 top?
Yeah, we know I like about that, Johnny. That started to tell me that the trend is starting to change directions.
Okay. So odds are, if you were doing good risk management, what would happen when it changed the direction?
9 times out of 10, I'm gonna get stopped out, Johnny.
And what are you going to do? Then you've got profits, right?
That's right.
And you were able to keep your profits.
Absolutely. I had my stop loss trailing the market.
Hey, you want to guess what the next slide is? What happens if you're not using proper risk management?
Every time I see this slide, I always like wonder, Barbara, why you do this to me? Yeah. Yeah,
But it's so important.
it is. I think it's so important, even though sometimes maybe I don't want to talk about it because it brings up old wounds. But like Johnny said, it's so important because it actually brings up old wounds that is a very good lesson to learn from. And if you're not familiar with this story with this sugar trade, very long time ago, sugar prices traded down to $1 something. All right. I mean, sugar was so low; it's never been that low since. As we speak today, sugar still has never traded that low again, and it was so low that when we saw this, we said, "Man, this is lower than when Ken got in." So my mentor caught sugar when it was low, and it took off, and he made a lot of money on it, and it was the rest was history from there. And we caught sugar at a price lower than what he got in it, and you couldn't tell us nothing about the fact that we wasn't gonna get rich from this trade. So we looked at this as an opportunity for us to do more, make more than what he made on his trade. Sugar took off and he made over $600,000 on it. Well, we thought we had a 6 or 7 figure opportunity that we were going to take advantage of in the sugar market. And we were every day we were sitting down, putting our plan together. And we had all this strategy what we was going to do. And so in the futures market, we can take advantage of something that's called internal financing. And what I mean by that, we can actually use the profit we make while we in a trade and use those profits to purchase more contracts while we trade, in a futures contract. All right. So I want to say that because you understand what it is that we did. So sugar was down here at the low, and which we gonna call it the floor. Sugar was on the floor, guys, and we was excited about it. So what did we do? We got in sugar and exercised our plan how we were gonna trade it. And that sugar went up. Every time sugar went up enough to get another contract, that's what we were gonna do. So there are 2 types of ways of using that internal financing. One is called pyramiding, and the other one is called pillaring. So I was doing the one that's called pyramiding, and Eric was doing the one that's called pillaring. So what's the difference? Let's say the margin was $600 to get a sugar contract. Whenever there was a $600 profit, when you're pillaring, once you make $600, you made enough to acquire a second contract. And that's what Eric was doing. So he started with one and he made $600. He purchased a second contract. So now he has 2 contracts. And every time he made $600, he got another contract. Well, in my example, I'm doing the pyramiding, and I had started with one as well. And then the second contract, when I got enough to get a second contract, that's what I did. But after that point, I got another contract when I was able to buy 2. And then the next time I bought 4. Then the next time I bought 8. So I was doing what's called pyramiding. And he was acquiring one at a time, what's called pillaring. So anyway, sugar took off. And we was doing this pillaring and pyramiding. And you couldn't tell us nothing because the market was going up and we was getting more and more contracts and we was making all this money. And our plan looked like it was working. Oh man, our head was bigger than the market. We getting ready to get rich off this one sugar trade. The market was going up. I was so excited, guys. I got so excited about the profit that we were making. I packed my whole family up, got everybody. Pack up, we're going to Disneyland, Disney World. I took my whole family to Disney World. I was so happy. This trade is going right in the direction that we said. So I'm all down in Disney World, and now at this point, I got like 88,000 in profit. And you can't tell Delvin nothing. Well, Johnny talked about when you don't use proper risk management. Y'all heard us talk about stop loss over and over and over.
Okay.
Somebody need to unmute. I mean, need to mute out. I don't know if that was John, whoever it was. If y'all can mute out for me, thank you. So anyhow, I'm up 88 grand, and I think, you know, at this point, I don't know. I can't remember. It was 20, 30,000 in profit. Well, remember Johnny said about not using proper management. Here's the mistake we made in this particular trade. We had no stop loss. So we always talk about always have a stop loss. So remember, we use an internal financial. So we're not trading with one contract. We got multiple contracts with no stop loss. And the market turned around. Remember how we just looked at the charts and the trend changed? The trend turned around and started trading back down. And now the market's trading against us. I'm in Florida in Disney World, happy celebrating, and all of a sudden the market's going the other direction. And I'm giving back the money faster than I made it. Okay? First of all, understand when I started out with one contract, it's different now because when the market turned, I got 16 contracts. So now it's going against me, and 1 point don't equal the same amount no more because I got 16 contracts versus when I started with one. And here we are with the market coming against us. It didn't take long for us to give the money back because what did we do? Oh, we just hung in there hoping the next day it's going to go back up. And the market kept going the next day. And then it kept going the next day. And long story short, I walked away from that trade with about $6,000 profit instead of 88,000. And I think Eric had, I don't know, 1,000 or two, if that. And it was a great lesson being new in the market, ego trading, and looking for a thrill seeker, home run trading. We got an opportunity to make a real good profit on it, but we really didn't know how to trade the market the way we was trying to trade it. But we learned a lot from it. Well, we can, help people not make the same mistake. Well, that's what Johnny talked about not using proper risk management. No stop loss. The market was going against us. I want to make sure I point this out too. At that time, my broker called me every day. She called me every day trying to get me to put, a stop loss in. And I didn't want to. So it wasn't that I didn't know, and it wasn't that I wasn't, thinking about it because my broker was calling me, hey, Dale, hey, just put a stop. And I didn't want to put a stop loss in. So these are the mistakes you make when you get in the market and you think you know what you're doing and you don't. And that's the famous sugar trade that that slide talked about, because that trade helped with a lot of things. It helped step back from the market, sit down and try to figure out what it is that we need to make some changes. And Eric, let me point this out too. Eric was so devastated from that trade, he stopped trading for a while. He was hurt so bad. What it did was help him understand a lot, stepping back and being upset because he was blaming the market. And I think we thought it was the market fault when it wasn't. It was our fault. And when you realize that, you realize that we could have done so much stuff different had we, follow some rules and learn how to actually use internal finance the proper way. But that's how the rules came about. Realize that, hey man, we got to stop. What we're doing is not working. Okay. You don't make 88 grand in the market and give it all back in a few days. That's when you know you need to sit down and figure out what it is you're doing wrong. But that's how that story came about. Don't get too excited. Control your emotions and don't take your family to Disney World, Johnny.
I thought it's never leave when you have an open, don't go on vacation when you have an open trade. Unless you've got a stop loss. So let me ask you a question.
Mm-hmm.
Did you risk more than 10% on one trade?
Oh man, Johnny, I broke all the rules, man. I had my whole account risk 100%.
Okay. Second question. Did you use a stop loss?
Absolutely not.
You already answered that question, right? So did you let your emotions get involved?
Oh man. Me too. On so many levels. I got so excited. Took the whole family. I'm talking about everybody. In-laws, everybody took. I got excited like I was rich already. And then when the market went against me, Johnny, you talk about emotions, boy. I couldn't even sleep. I was so sick every night. Because all I could think about, oh man, I hope to turn around tomorrow. Oh man, emotion was kicking in on so many levels, Johnny. Woo.
Did you follow the charts? Did you see a change in the trend, but you didn't believe it?
No, I wasn't following my chart, I felt like I had caught it at the bottom on the floor. And at this particular time, I just needed to have enough money to ride it out if it went against me and stop following the chart at that time.
The point I guess I'm trying to make is we've got a bunch of rules that we teach on lesson 1. And the thing is, he would have walked away with a whole lot of money if he would have followed the rules, right?
Yeah.
So let's just kind of go over some of this. So your entry point, some of the rules for risk management, the entry point is we want to be below the number 2 on a top formation and above the number 2 in a bottom formation. Okay. Why are we looking at number 2 and instead of trying to pick the bottom? We want that 1, 2, 3 top or bottom formation to confirm itself. We never want to risk more than 10% on one trade. How do we protect that risk? We use stop loss. The stop loss typically is at the number 3.
Mm-hmm.
Okay. So if and only if it doesn't represent more than 10% of your net holdings.
Mm-hmm.
Okay.
Good point, Johnny.
Now, if you pick the market correct and it's taken off, then you want to use a trailing stop loss, one that trails behind your entry and helps you secure your profit. Okay. And what are our targets? The number 1 target is 50% retracement.
All right.
So this little slide right here can help you on all of your trades. Okay. So here's a chart that represents that.
Johnny, everybody need to take a screenshot of that slide.
Yeah, I'll go back. If everybody would, you want to take a screenshot of this? Take a picture with your camera.
So important.
All right, we're coming up. I don't know how many slides she has here.
Should be close to the end right there. I think.
Yeah. So here's a representation of what we're talking about. Let me get my annotator out real quick. All right. Here's your 1, 2, 3 top. Okay. So this purple line, okay, would be your entry point. It went down to form a 2. In other words, it changed direction. It went down, formed a number 2, went back to a number 3. And when it goes back towards the number 2, then this is where you would enter the market. And the number 3 would be your stop loss, where you set it. So in this case, went down to 2, up to 3. It never came back up to our stop. Came down, formed another 2, another 3. Well, guess what? If my stop loss is still sitting way back up here and the market changes and goes way back up, then I lost all my profits. So I want to continue to take and move my my number 3 or my stop loss. Here, it hits the 50% retracement. All right. So this is our target. Now it went below that. But if you'd moved your stop loss back up here, when it came back up, odds are you would have been stopped out. All your profit was secure from this point to this point, you know, but it continued on. So if you didn't get stopped out, you were able to continue to write it down until it hits a new bottom, which was here. And then you're looking at your 1, 2, 3 again. All right.
Excellent.
We have the next slide is a role play for the how to place an order with your broker. If you want to do that, we can. If you don't, we can go that on the next one.
Yeah, let's do that on the next call.
Okay.
Just for the sake of time.
All right. So just remind everybody that we have the retreat coming up, April 24th through the 27th.
Yes.
All right.
Looking forward to seeing everybody. And then I think we can open it up there, Johnny.
Q&A. Anybody have any questions on what we've covered?
Yeah, I do.
Okay.
So I'm interested in the stop loss. When would you know when to set it, or how high or how low you would set it? And there was something about the chart that you went over and said that that was a little bit, it threw me for a loop, but I'll get back to it once I review the charts and get a little bit more well versed in there. What's going on?
Okay. So going back to your first question about stop loss. I think you said, where would you set the stop loss? Is that correct?
Yes, that's correct.
Okay. You remember when Johnny went through the 1 and the 2 and the 3 point on the chart?
Mm-hmm.
So we use that number 3 point as our stop loss. You know, that's going to be a support and resistance level depending on which way the market's trading. All right.
Okay, the red line at the top of the chart.
Yeah. So in this particular chart that you're seeing right here on the screen, this is what happened. We happen to be a 1, 2, 3 top, meaning that the market traded up. It started to top out, meaning that it traded up in an uptrend, and then it started to change directions, and that's what's considered to be a topping formation, and we call that a 1, 2, 3 top. When the market started to trade down, it made a 1, 2, 3 top before trading down into a downtrend. And when you got into this trade, the number 2 would have been your entry. So when the market traded just below the number 2, that's where you would have entered the market. And your stop loss would have been where the number 3 is, right above that number 3. So if you got in below the number 2 and the market traded up going against you, your stop loss would have been at the number 3, getting you out of the market. You with me?
Yeah, I see it. I see it.
And we use that number 3 because it's either going to be a support or resistance level, depending on the direction of the market.
This is a perfect chart for us to talk about that. Let's say you have 5,000 in your account. Okay.
Yeah.
Now, the buy-in here would have been at 486 3/4. Okay. And your stop loss would have been at 496. All right. Now, it depends on the commodity. So corn, for every point, right, is $50, right?
Mm-hmm.
So if you got in at 486, and in this instant, you would have sold a contract at 486.
Okay.
10 times 50 is 500, right?
Yes, it is.
So that that would represent 10% of your net holdings of 5,000, correct?
Yes, it would.
Okay, so you're willing to risk $500, right, on this trade, or 10 points.
Okay.
So 10 point would be at the number 3.
At the stop loss.
That's where you would put your stop loss. So we can do a quick role play here. So Delvin, I want to sell one contract of corn, of December corn, right?
Yeah.
486 3/4, right?
All right.
Mm-hmm.
And when I get that order filled, immediately I want to say, I want to sell one contract. Excuse me. I want to buy one contract at 496.
All right.
At the 3.
All right.
I've sold one. If it goes back up to 496, then I buy it back and get out of the trade. And I've lost $500. But in this case, right?
I'm with you.
In this case, it dropped on down to 470 something,
Yeah, let me look over there and see what's over there.
right?
That's yeah, 470,
Okay.
exactly.
And then it went back up to 480, which isn't anywhere close to my stop loss. And then it went back on down to way below the 50% retracement. And
Yeah,
at that point in time, I could have, so Delvin, my buy order for stop is a good till cancel, correct?
Correct.
So I want to cancel that order, and I would have put another order in to buy at 461 3/4.
buy low and sell high.
Okay, because I'm still in the contract and good till cancel. So I placed an order. Now my new stop loss is at the 50% retracement, which was my target all along.
Oh, it goes down to 2, then back up this way. Oh, I see.
Okay,
I see.
so I keep moving my stop loss down to the next 3.
Okay.
I have a
You
question.
got it, Stephen?
Yeah,
So
yeah, I do. I do.
initially, your stop loss would have been above the number 3 on this chart in this scenario, and the market kept trading down after you got in. So you didn't have to get stopped out. You actually got in profit when the market started trading down. And what Johnny's saying is you would have been following the market by moving your stop loss down as the market kept trading down. And what that does is allows you to start locking in some of the profits you're making. So
Mhm.
you won't do what I did in sugar. You see what I'm
Okay.
saying? So
Yeah,
you're trailing the market and following it with your stop loss. And what you're doing is trying to make sure you don't have too much risk on the trade.
right.
Because you're gonna want, if you leave the stop loss above the number 3 and the market keeps going down, at some point you're gonna be risking way more than 10% if you don't move your stop loss.
Correct.
So
Did that answer your question, sir?
Yes, it did. Yes, it did. It did.
Lucky, you have a question?
Yeah, I asked Delvin this question a few weeks ago, and it was a little ahead of time, and I'm asking another question that's probably a little bit ahead of time. But I saw where you showed stop loss in that one slide, and then below it said trailing stop loss. What you said, Delvin, I think a couple of weeks ago was that, because I asked you what happens if the market continues to move and your stop loss doesn't move, you potentially could lose all those profits or not take advantage of the continuing trend. My question is there a way, is that trailing stop loss, is that a way to automatically, without you having to do it, you've already put that in so that when the market moves, that it moves your stop loss, or that's something you physically have to do every time there's a 1, 2, 3 switch?
great question because that what you just said, that's the difference between the two. So we have a manual stop loss and then we have a trailing stop loss. And the difference between the two is one is set automatically and it's gonna move based on how you set it. And the manual will be something where you would go in and move it yourself, or if you called the broker and had them move it. So in the case of a trailing stop loss, if I want to trail the market by 10 points, right? I got in, let's use this example. I think Johnny said 486 and the stop loss was set at 496. I think that's what Johnny said. As the market traded down, if I set my stop loss to trail the market by 10 points, as the market's trading down, Lucky, my stop loss is going to keep trailing behind the market by 10 points. I don't have to do anything once I set it. That makes sense?
Yeah, and then the opposite would be true. You can set a trailing stop loss if the market's moving up as well, then, correct?
Correct.
Oh, gotcha. Thank you.
Yeah. Great question. Yeah.
That's done through the particular brokerage house that you use.
Yeah, I was getting a little ahead of ourselves, but since we were on the subject.
No, I think you're right on time.
Yeah, you're right on time, because we're talking about this, and this is a case where we are looking at a scenario of the market trading down, and our stop loss would be trailing the market down. And it will do the same if the market was trading up. We would still use a trailing stop loss and just keep trailing the market up. So the trailing stop loss is something we can set, and it'll follow and trail the market. And the manual stop loss is one that we can move ourselves, or we can call the broker and have them move it for us.
So
But you have to do it when you're using a manual.
Yeah, yeah. So the scenario I asked you a few weeks ago was, I was using Bitcoin as an example, and so we buy Bitcoin at 33, and it goes to 66,000, and we're like, and we're thinking we should get out of the market, but it keeps going and it keeps going, and we don't want to lose any profits. And then it goes to 100 and whatever it was, 108, 111, or whatever the hell it went to. And it's like, so we make all that profit, and now it's back down to 80. So it's gone down from 110 or whatever it was down to 80 again. So when do you set the trailing stop loss? Is that something that I mean, I guess we're going to probably get into that in the future, but because we want to ride this thing as long as it goes, whether it was sugar in your case or Bitcoin or whatever. We want to ride it until it just keeps going and going and going. But not if, but when it starts its downtrend or uptrend, whatever the case may be, we want to make sure that our stop loss is in place so that it goes to 110, and now it drops down to 80. Well, we got out of the market because our trailing stop loss was maybe set at 100. So, okay, we lost 10 grand per coin, but we didn't lose 30 grand per coin because we had our trailing stop loss. When do we put that trailing stop loss? I guess you guys will be talking about that at a later date.
Yeah. So you want to put a stop loss in whenever you enter the market, whenever you get in the trade, right? Whether it's manual or trailing, whichever one you choose to use, you want to be in the market using one always. All right. And then you want to always remember to keep in mind that when you're putting the stop loss in, you need to make sure you are paying attention to your account size. Okay. How much are you willing to risk on this trade, and how much can you afford to risk on the trade? Because remember, we don't want to be risking our whole account on the trade. So when you trade in a market that's volatile like Bitcoin and how sugar was when I was in it, we don't know if we're going to be able to stay in the trade that long up to that because of the volatility of the market. We could get stopped out. It could trade down and hit our stop loss and then continue to keep going to 100,000. You see what I'm saying? So if you give the market enough room and where you can ride through those price swings, you may be able to ride it out to a profit of 100,000 from 30,000. But the probability of that happening is, maybe not that great when it's volatile, because it's not going to always go up every day, and it could come down and hit you and hit your stop loss. Is what I'm saying. But when I use a trailing stop loss, I'm looking at the point value of what it is that we're trading. You remember how we talked about point value when we went to the contract specs? In this case, I think that chart was a coin trade. In the coin trade, in the coin market, every cent equals $50. And in this particular case, in that example, was a 1, 2, and 3, we was only risking 10 points, right? And another way I set my stop loss, I don't know if you remember that video we watched last week where he talked about using a trailing stop, a 2-day trailing stop. And what is a 2-day trailing stop, Lucky? That means that when I set my stop loss, it's gonna be based on the bars. Excuse me, I got something in my throat, y'all. It's gonna be based on the bars or candles, and I'm gonna use the longest two in the last 2 days when I set my trailing stop loss. We'll get into using some example of what this look like, but we want to look at our count size to make sure we don't break the rules, and then we can use what's called a 2-day trailing stop. And we'll, on another lesson, we'll actually go over some examples of what that look like on the chart. How about that, Lucky?
Yeah, that'd be great. As far as the lesson last week, I really need to watch that again because I was struggling to keep up. And I was waiting for it to get posted. Is that going to be posted on YouTube so I can watch that again?
Yes, and Barbara said she just had so much going on throughout the week that she didn't get it uploaded yet. But yeah, she's gonna get that one and this one uploaded this week.
Okay, great. Perfect. Thanks.
Hey, Lucky.
Yeah.
Okay, let me answer your question. Okay. Let me move this here. All right. This is exactly what you were talking about. This chart is a 6-month chart. And so the market went up to what, 113,000?
Right.
In Bitcoin?
Right.
All right. So now we were running the market up. All right. So as soon as that failed, this would have been a 2 and this would have been a 3. All right. And so what happens here is the market goes up and changes direction and hits a 2 and then goes back up to retest the number 1. But since this did not break the number 1,
Right.
your trend failed.
Right. Gotcha.
Which would have told you to get out.
Gotcha.
Okay.
Yeah.
Now we get, come on. We get another number 2. And we get another number 3. Well, guess what? Now we're hitting lower lows and lower highs.
Right.
So now we're establishing a downtrend.
Right.
That means we get out of the market.
Yeah. Gotcha.
We go to USDT.
Yeah.
All right.
Yep.
However, in the futures market, we can actually sell a futures contract and play the market down as well.
Gotcha.
Yeah.
But if you're just playing Forex, where you can't, in Forex, you can also sell contracts. But if you're not, if you're just, you're just using your own Bitcoin and USDT.
Right.
Well, you go to USDT until such time as the market changes direction again.
Gotcha. Okay.
And the place you would look is the 50% retracement. So, yes, we can. So what we're teaching you is you can use this on all markets, stock market, crypto, whatever.
Right. Gotcha.
Great. Excellent question, man. Excellent. Like we want to always have that stop loss in, no matter what, even if, whether we're using a manual or we're using a trailer. And it's just a personal preference which one you prefer. You know, if you want to manually move it, you can use a manual stop or you can use a trailing stop. And I prefer the trailing stop because I stay busy all the time. And I don't sit in front of the market, sit in front of the screen. So the trailing stop works best for me because I can set it and I don't have to be trying to go back and make sure I got my eye on the market, see what's going on. And that's why the trailing works best for me because I can set that stop loss and have it in place and it's going to follow the market while I'm busy doing all this other stuff.
So
Makes sense? Huh?
so had
Come
you
on,
had so you had had you had a trailing stop loss on your sugar trade and you're at 88,000, you're at Disney World, and now it drops, but your stop loss, maybe you lost 8,000 of it, but you just still went home with 80 grand versus, you know, you wouldn't have got the 88 because there was that between the profit between the stop loss and the high, you know, you'd have lost that, but you wouldn't have lost any more.
Right. And then it wouldn't have been so bad. I was married at the time and I was dreading that conversation with my wife. I done gave all that money back.
All right, thank you.
Yeah, and that's a good example of how we can get in the market and not know what we're doing per se, and think we know what we're doing. And a lesson like that, which is such a costly lesson, but it teaches you so much to never do that again. You won't catch me in the market not protecting myself again. You know what I mean? Like, yeah,
Absolutely.
yeah. Any more questions? Great questions. I appreciate y'all. Any more questions? We covered a lot tonight. I know one of the things that I always kind of seem to have to talk about and go over multiple times is the concept of how in the world can I sell something, Johnny, and I don't own it? How can I sell something? I don't own it. What you mean sell it?
Because you're dealing with a contract. You're not dealing with the commodity itself. It's a commitment to either deliver or to buy. It's a contract.
Yep. Does everybody understand this? And it's okay if you don't, because it took all of us a minute to get it.
No, I understand. I just got to get deeper into it and do a lot more of the homework that you said and that I've been hearing about since I start getting on the call. I believe the book that will help me out a lot more than I'm standing right now. And just explaining that part of the chart with the stop loss is opening up some doors. So
Yeah, the more you hear it, the better, and the more you know that cliche that we've been hearing. You know, the mother of all learning is repetition. You got to hear it more than one time, over and over and over. And the more you hear it, the more it starts to make sense. And just like the chart, you got to look at these charts. The more you look at these charts, the stuff that we going over start to pop out. That's why I say, they talk to you, and you may be saying, "Man, they ain't saying nothing to me yet." But the more you look at these charts, the more you'll see that these charts are telling a story. They're telling you what's going on. You just got to learn how to read them. And the more we look at them, the more easier it start to become to you.
okay, I appreciate it.
Yeah.
Hey, hang on just a second. Hey, Lucky.
Yes, sir.
What's the price of Bitcoin telling you on this chart?
I mean, it's telling me that it's on a downtrend, and still is, because now you got a new number 2 at 75. And then number 3 would be at 90 or just below 90.
Well, we're looking for a 3.
And the 3 would be at, it looks like 90, just below 90,000.
So,
And that's 3 tops and 3 bottoms. So that would establish a trend.
so I got a question for you.
Sure.
What happens if we break 89,000 on the upside?
Then if we break 89, then we're on an uptrend. It's changing directions. Is that correct?
It's a very good possibility. Okay. And the number 2 there at 75 becomes the number 1. But it'll
Gotcha.
only be confirmed if the next number
Go-
2 is above the 89.
Right.
But see, we could, and this is what, forgive me, folks, I want y'all to understand that we're just like y'all. I want Bitcoin to go to 200,000, or I want it to go down so I can buy more. But this number 1 up here, can I tell you that is around that was after the election. Number 3, this number 3 was at inauguration. Can everybody remember what they were talking about Bitcoin and cryptocurrency when President Trump gets in?
Sure. And I would predict it's going to do it again, because now they're talking about the SEC dropping all the regulations, and Trump's crypto project, which is a DeFi project, Liberty, what is it called, Don? World Liberty is going to be, and so when SEC drops all this regulations and stuff, I think you're going to see another market swing, because of what you just pointed out. Every time it looks like something's moving forward with the Trump administration, the investors get really happy, and they start throwing a lot of money at it. And then, of course, consequently, everybody starts following, which pumps the price up until it reaches its peak. And then all of the non-professionals, when it starts a little bit of a downtrend, they start selling, and then we see another downtrend. And so.
Okay, I got a question for you real quick.
Sure.
I mean, let's talk risk management. The first question is, what Lucky just said, is that technical or is that fundamental information?
That's fundamental information.
Okay. So give me just a second. Let's talk about the chart. We're not going to talk about any of that other. 113, 140 plus 69, 602 equals divided by 2, 91.
That's your 50% retracement, correct?
Correct.
So that's what your stop would be.
So question, have we retraced 50% from the top?
More so, beyond 50%.
Absolutely. So if that's our target, what are we looking for right now?
we're looking to put, we're looking for the market
to change directions, right?
to change directions. And we're also looking for the market to break 91,371, right? To show that it's continuing up.
We're either at a sideways trough right now,
Right, which is what it looks like.
okay? And, we're at a really good spot here on Bitcoin. We're looking for a 1, 2, 3 bottom and watch it head the opposite direction. Or if it's sideways, then we can play both sides of it, and whichever way it breaks out, then we're the winner.
Yeah.
That's everything that we've talked about today in today's class.
You ask a good question about, is that fundamental or technical trading? And I'm thinking back to the movie that Delvin had us watch. And there are fundamental traders, there are technical traders. And the way my mind works, it is, I tend to be more fundamental because I'm looking at what causes things to happen, but the technical is so important because the technical has to validate the fundamental. If you're just using one or the other, I think you're missing the, seems to me you're missing the boat. If I'm just a technical trader, I'm ignoring the news and things like you just said, the election, the inauguration, changes in regulations. I mean, this is how, what's her name? Nancy Pelosi gets so wealthy, is because she knows ahead of time what laws or things are going to be, regulation, who's changing CEOs, whatever, and has a lot of inside knowledge knowing what's going to happen. So she's probably all fundamental. But I think from somebody's standpoint, like where we're at, I want to look at the fundamentals and see what would cause the market to move, whether it's, because I'm not just interested in crypto, I'm interested in commodities and stocks. I just saw where a big motorcycle manufacturer CEO just either got fired or left or whatever, and that's going to have a change in the marketplace. So I want to look at the fundamentals, what may cause something to happen, but then I want to look at the charts and be able to see, are the charts validating what I am speculating with the news?
And you said it absolutely correct there. It usually validates